You want to trade, but apparently there's different ways to enter and exit a trade. Let's learn more about these different types of orders. What's up, everyone? This is Eric with Theme Options Trading, and we're in our 3-minute beginner series, and today we're discussing order types. There are 4 main types of orders: a limit order, a market order, a range order, and a Good-til-Cancel or GTC order. Let's start off by first discussing a limit order. In my last video, I discussed the bid and the ask, and this is where a limit order comes into play. A bid is the highest outstanding limit buy price. A ask or the offer is the lowest outstanding limit sell price. So a limit order, the user does not want to sacrifice on price, but he does risk the fact that his entire order may not get filled. The market order, for the most part, does not care about price. The main concern with a market order is entering the trade for the full amount of shares at a potential worse entry price. A market order sacrifices price, and that's the risk, but he ensures that his entire order is getting filled. There are some small, rare circumstances where this is not always the case, but we are going to assume that a market order always fills the entire order. Each order type has its place. Sometimes I use a market order, sometimes I use a limit order. It's all dependent on the trade. But for the most of the time, I use a market order. I want to fill my entire order, and I take into consideration the price I'm sacrificing or the bid-ask spread that I'm sacrificing, and that's okay. That brings us to a range order. A range order simultaneously sets a stop and a profit target. The stop loss is set as a stop market order, meaning if the stock or options contract trades at this price, it will trigger an order for the entire share size. The profit target is set as a limit order, and I use range orders all the time because I can simultaneously set my stop and my profit target and not think twice about it. What makes the range order so effective? It technically is an OCO, or a one cancels the other order type. For example, if your stop hits on a range order, your limit order will cancel, and vice versa is true. And that brings us to the last type of order, a GTC order or a Good-til-Cancel order. You apply this to your limit order. What this says is you want this limit order to remain until you cancel it. Sometimes brokers have a max set for this GTC order type, and typically that is 30 to 90 days. So if you do not cancel your GTC order within 30 or 90 days, your broker will cancel it for you. And that's it. As I mentioned in this video, there is another video that is important to watch first before watching this, and that is the bid-ask spread video, and I'll link to it now. Thank you again for watching. Subscribe to my channel if you haven't already. Like this video, share it. Until next time.